Preparing for a financial analyst at NRG Energy interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through your financial analysis process. I start by clarifying the decision the analysis should support. Then I gather historical financial, operating, and market data, check its integrity, and identify the key value drivers. I build a transparent model with clearly labeled assumptions, reconcile outputs to reported results, and test sensitivities around the most uncertain variables. Finally, I summarize the conclusion, explain the risks, and recommend an action. For NRG, I would connect financial results to customer demand, power prices, generation, and hedging. While answering, focus on understanding the business question, collecting reliable data, validating assumptions, building a structured analysis, testing sensitivities, and communicating conclusions with clear recommendations and limitations. Question 2. Why do you want to work at NRG Energy? NRG interests me because it combines an essential service with genuinely dynamic financial drivers. The business is influenced by customer demand, wholesale power prices, fuel costs, weather, regulation, and hedging decisions, so analysis has a direct commercial impact. I also like the mix of generation and retail energy, which requires both operational and customer-oriented thinking. This role would let me apply rigorous modeling while learning how financial insights support decisions in a changing power market. Make sure to cover NRG's combination of power generation, retail energy, customer solutions, market exposure, analytical complexity, and your motivation to connect financial analysis with operational and commercial decisions. Question 3. How do the three financial statements connect? The income statement produces net income, which flows into retained earnings on the balance sheet. The cash flow statement starts with net income, adjusts for non-cash items such as depreciation, and reflects working capital changes to calculate operating cash flow. Capital expenditures appear as investing cash outflows and increase property, plant, and equipment, while debt issuance, repayment, and equity activity appear in financing cash flow. The balance sheet must ultimately balance, providing an important modeling check. In your answer, talk about net income flowing into retained earnings, non-cash items and working capital driving operating cash flow, capital expenditures affecting investing cash flow and fixed assets, and financing activities changing debt and equity. Question 4. What financial metrics would you monitor for NRG Energy? I would monitor revenue and gross margin by business, adjusted EBITDA, operating cash flow, free cash flow, leverage, liquidity, and capital expenditures. For retail operations, customer additions, churn, usage, acquisition cost, and contribution margin are important. For generation, I would track availability, realized power prices, heat rates, fuel costs, and dispatch economics. I would also compare results with budget and prior periods, separating volume, price, mix, hedging, and one-time effects instead of relying on a single headline metric. Be sure to mention revenue, adjusted EBITDA, free cash flow, operating cash flow, leverage, liquidity, gross margin, customer retention, churn, generation availability, realized power prices, and business-specific interpretation. Question 5. Explain the difference between EBITDA and free cash flow. EBITDA measures operating earnings before interest, taxes, depreciation, and amortization, so it helps compare operating performance without capital structure or depreciation policies. Free cash flow is closer to actual financial flexibility. It generally starts with operating cash flow and subtracts capital expenditures, while also reflecting working capital, taxes, interest, and other cash items. A business can report strong EBITDA but weak free cash flow if it requires heavy investment, experiences unfavorable working capital, or pays significant cash interest. Focus on EBITDA as an operating profitability measure before interest, taxes, depreciation, and amortization, while free cash flow reflects cash available after capital expenditures, working capital, taxes, interest, and other cash items. Question 6. How would you build a budget for an energy business? I would build the budget from operating drivers rather than simply applying a growth rate. For retail, I would forecast customers, churn, usage, pricing, acquisition costs, and bad debt. For generation, I would model capacity, availability, dispatch, power prices, fuel costs, maintenance, and hedges. I would incorporate seasonality, planned outages, capital spending, financing costs, and taxes. After creating base, upside, and downside cases, I would review assumptions with commercial and operations teams before finalizing targets. Make sure to cover volume and price assumptions, customer and generation forecasts, fuel and power costs, hedging, staffing, maintenance, capital spending, seasonality, scenario analysis, and review with operational stakeholders. Question 7. How would a change in wholesale power prices affect NRG? The impact depends on NRG's net exposure and hedging position. Higher wholesale prices can increase generation revenue, but they can also raise procurement costs for an under-hedged retail book. Hedging may reduce near-term volatility while limiting upside, and the effect can differ by market, contract tenor, and location because of basis risk. I would analyze contracted versus uncontracted volumes, fuel costs, customer pricing, and settlement timing before concluding whether higher prices improve total company earnings. In your answer, distinguish generation and retail exposures, discuss hedging and contract positions, explain effects on revenue and margin rather than assuming a simple relationship, and mention timing, geography, and basis risk. Question 8. What is hedging in the power and retail energy markets? Hedging means using contracts or physical positions to reduce exposure to uncertain prices. An energy company may use forwards, futures, swaps, options, or fuel contracts to protect expected generation margins or retail procurement costs. The objective is not necessarily to maximize every market movement, it is to make cash flows and margins more predictable. I would evaluate hedge effectiveness, volume mismatch, basis risk, liquidity, counterparty exposure, and whether accounting treatment creates earnings volatility despite economic protection. While answering, explain hedging as reducing price risk, identify physical and financial instruments, distinguish economic protection from speculation, and discuss basis, volume, liquidity, counterparty, and accounting risks. Question 9. How would you analyze a variance between actual and budgeted EBITDA? I would begin by quantifying the total variance and then separate it into revenue, operating cost, and timing components. Revenue analysis would distinguish customer volume, customer price, generation output, market prices, and mix. Cost analysis would isolate fuel, purchased power, maintenance, labor, and other expenses. I would separately identify hedge settlements, outage timing, weather effects, and one-time items. The final bridge should explain both what happened and whether the variance is temporary, structural, or actionable. Be sure to mention price-volume mix decomposition, customer and generation drivers, fuel and power costs, hedging, timing, one-time items, foreign or regional effects, and management actions. Question 10. How does working capital affect cash flow for an energy company? Working capital can create significant cash swings even when earnings are stable. Higher receivables consume cash, while increased payables provide temporary financing. Energy companies may also hold fuel inventory or post collateral and margin as market prices move, creating additional liquidity needs. Customer deposits can support cash flow, but seasonality and settlement timing matter. I would analyze balances against revenue, market conditions, and historical patterns, then distinguish sustainable operational changes from timing-related movements. Focus on receivables, payables, inventory, collateral and margin requirements, customer deposits, seasonality, settlement timing, and why reported earnings may differ materially from cash generation. Question 11. What is the difference between fixed and variable costs in power generation? Variable costs change with production, such as fuel, emissions costs, and certain operating expenses. Fixed costs remain relatively stable over a relevant output range, including plant staffing, property costs, and some maintenance commitments. The distinction matters because dispatch decisions generally compare expected power revenue with incremental variable cost, while fixed costs influence longer-term profitability and asset viability. I would also test the relevant range, because maintenance, staffing, and capacity costs can step up when utilization or operating conditions change. In your answer, define costs with respect to output, provide generation examples, explain short-run dispatch decisions, and connect the distinction to operating leverage, break-even analysis, and maintenance planning. Question 12. How would you evaluate a capital investment in a power asset? I would forecast incremental after-tax cash flows, including construction spending, operating costs, fuel, maintenance, expected generation, power prices, taxes, working capital, and terminal or decommissioning costs. I would calculate NPV using a risk-appropriate discount rate and review IRR, payback, and value creation under multiple scenarios. Sensitivities should include power prices, utilization, construction overruns, delays, fuel costs, and regulation. I would also consider strategic benefits, reliability value, and whether the project improves portfolio diversification. Make sure to cover incremental cash flows, construction spending, operating assumptions, useful life, taxes, working capital, discount rate, NPV, IRR, sensitivities, regulatory risk, and strategic value. Question 13. Explain NPV and IRR, and which one you prefer. NPV is the present value of future cash inflows and outflows discounted at the required return. IRR is the discount rate that makes NPV equal 0. I generally prioritize NPV because it measures absolute value creation and handles project scale more reliably. IRR is useful as a communication metric, but it can be misleading with unconventional cash flows or mutually exclusive projects. I would use both, alongside scenario analysis, risk assessment, liquidity constraints, and strategic considerations. While answering, define both measures, explain the reinvestment and scale limitations of IRR, emphasize value creation through NPV, and note that decisions should also consider risk, capital constraints, and strategic factors. Question 14. How would you value an energy company using a DCF? I would forecast segment revenue, margins, operating expenses, taxes, capital expenditures, depreciation, and working capital to derive unlevered free cash flow. For an energy company, I would normalize power prices, fuel costs, generation, customer growth, and hedge impacts rather than extrapolating one unusual period. I would discount cash flows using WACC, calculate terminal value carefully, and bridge enterprise value to equity value by subtracting net debt and other claims. Sensitivities would focus on market prices, margins, WACC, and terminal assumptions. Be sure to mention segment-level forecasts, normalized power and fuel assumptions, unlevered free cash flow, WACC, terminal value, net debt, sensitivities, and avoiding double counting of hedges or non-recurring items. Question 15. How do you calculate WACC? WACC is the weighted average of the after-tax cost of debt and the cost of equity, using market value capital weights. I would estimate cost of equity with CAPM, the risk-free rate plus beta times the equity risk premium, then assess whether company or segment-specific risks require additional judgment. Debt cost reflects current borrowing conditions and tax deductibility. The discount rate must match the cash flow definition, currency, inflation basis, and risk profile of the assets being valued. In your answer, cover market value capital weights, cost of equity using CAPM, after-tax cost of debt, relevant risk adjustments, and the importance of matching the discount rate to projected cash flows. Question 16. What is enterprise value, and how does it differ from equity value? Enterprise value represents the value of the operating business available to both debt and equity holders. A common bridge is equity value plus debt, preferred equity, and non-controlling interests, less cash and cash-like investments. Equity value is what remains for common shareholders after those claims. Enterprise value should be compared with operating metrics such as EBITDA, while equity value is paired with net income or earnings per share. Consistency prevents misleading valuation conclusions. Focus on enterprise value representing value attributable to all capital providers, the bridge from equity value using debt, cash, and claims, and the importance of matching valuation multiples with EBITDA or other operating metrics. Question 17. How would you assess NRG's liquidity and leverage? I would review unrestricted cash, committed revolver capacity, expected operating cash flow, debt maturities, interest payments, capital commitments, and collateral requirements. Key metrics include gross and net leverage, interest coverage, free cash flow conversion, and covenant headroom. I would stress test lower power prices, weaker customer collections, higher margin requirements, and operational disruptions. Liquidity is not just a balance sheet figure. Timing matters, so I would map weekly or monthly cash needs against available funding sources. Make sure to cover cash balances, revolver availability, operating cash flow, debt maturities, interest expense, net debt, leverage ratios, collateral needs, covenant headroom, and downside liquidity scenarios. Question 18. What are the main risks in an energy company's financial forecast? The largest risks can include wholesale power and fuel prices, weather-driven demand, plant outages, transmission constraints, regulatory changes, customer churn, counterparty credit, and liquidity requirements. Forecast risk also comes from incorrect hedge assumptions, weak data, or double-counting operational improvements. I would rank risks by earnings and cash flow sensitivity, then build base, downside, and severe cases. I would clearly document assumptions, monitor leading indicators, and update the forecast when market or operating conditions change. In your answer, discuss commodity prices, weather, demand, outages, fuel supply, regulation, credit, liquidity, hedging, customer churn, model risk, and how scenario analysis supports decision-making. Question 19. How would extreme weather affect your forecast? Extreme weather can increase demand and potentially power prices, but it can also create outages, fuel constraints, transmission issues, and higher operating costs. Retail customers may consume more, while collections and bad debt could deteriorate if economic conditions worsen. Generation output depends on asset availability and weather conditions, and hedges may limit or reshape the financial impact. I would model regional and seasonal scenarios, quantify both EBITDA and liquidity effects, and avoid assuming higher prices automatically produce higher earnings. Be sure to mention demand changes, power and fuel price volatility, generation availability, customer collections, hedging, regional exposure, operational disruption, and separate upside revenue from liquidity and cost risks. Question 20. How would you analyze a new retail energy customer acquisition program? I would estimate customer acquisition cost, expected customer tenure, usage, pricing, gross margin, churn, bad debt, service expense, and procurement or hedging costs. Those assumptions produce contribution margin, customer lifetime value, and payback period. I would compare the economics with hurdle rates and test sensitivity to shorter retention, lower usage, higher acquisition costs, and adverse market prices. I would also consider capacity to serve customers and whether growth improves scale without creating disproportionate working capital or collateral needs. Focus on customer lifetime value, acquisition cost, expected usage, pricing, gross margin, churn, bad debt, servicing costs, payback period, capital requirements, and sensitivity to market prices and retention. Question 21. What is a good financial model design for NRG? I would build the model in modules: historical financials, operating drivers, market assumptions, customer or asset schedules, income statement, cash flow, balance sheet, and valuation. Inputs would be separated from formulas and outputs, with consistent units, dates, and sign conventions. I would include balance checks, error flags, scenario controls, and reconciliations to reported results. For NRG, modularity is especially valuable because customer, generation, commodity, and hedging assumptions may change independently. While answering, emphasize modular structure, separate assumptions and outputs, historical data integrity, operating driver schedules, clear links, checks, scenario controls, documentation, and usability for forecast updates. Question 22. How do you ensure accuracy in Excel or financial models? I use reliable source files, preserve raw data, and document assumptions and transformations. I separate hard codes from formulas, use consistent formatting, and add checks for balance sheet balance, subtotals, sign conventions, and unexpected changes. I independently recalculate key outputs, compare results with historical patterns, and test extreme cases. Before distribution, I review formulas and links, confirm the version, and ask another person to challenge important assumptions. Accuracy is both mathematical and process-driven. Make sure to cover source verification, independent calculations, formula review, checks, controlled inputs, version management, reasonableness testing, peer review, and documenting changes so another analyst can reproduce results. Question 23. Tell me about a time you explained complex analysis to a non-financial audience. In a prior project, operating managers questioned why profit was below budget despite higher revenue. I built a simple bridge separating customer volume, pricing, input costs, and timing, then presented only the drivers relevant to their decisions. I avoided accounting jargon and used one concrete example to show how higher volume could still reduce margin. The team identified a procurement issue and changed its purchasing approach. That experience reinforced that clear communication turns analysis into action. In your answer, use a concise situation action result structure. Explain how you simplified technical concepts, connected findings to business outcomes, listened to questions, and confirmed understanding without sacrificing accuracy. Question 24. Describe a time you handled competing deadlines. When two reporting deadlines conflicted, I first clarified which deliverable supported an external commitment and which had flexibility. I mapped the required analyses, completed the high-risk data work first, and communicated a realistic timeline to both stakeholders. I reused validated schedules where appropriate but still performed targeted checks on new inputs. I delivered the time-sensitive report on schedule and agreed to a later completion for the secondary analysis. Early communication prevented surprises and protected quality. Be sure to mention prioritization by business impact and deadline, communication with stakeholders, breaking work into milestones, quality controls, escalation of conflicts, and delivering accurate analysis under pressure. Question 25. What questions would you ask the hiring manager about this financial analyst role? I would ask which decisions this role supports most directly and how success is measured during the first 6 months. I would also ask about the reporting and forecasting cadence, primary business partners, systems used, and the balance between recurring reporting and ad hoc analysis. Given NRG's market exposure, I would be interested in the team's approach to scenario planning, hedging analysis, and liquidity monitoring. Finally, I would ask what separates strong analysts from average performers on the team. Focus on the team's priorities, reporting cadence, key business partners, systems and data, success measures, major current challenges, development opportunities, and how the role supports NRG's strategic and operational decisions. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.